guys, this is Steven, founder of Phoenix FXC. I just wanted to go over a video on risk management with you guys. So let's begin. One of the quotes that I commonly tell people is learn how not to lose money first and then learn how to make money. This is something I preach to all the people I teach in the Forex industry. So, risk management might be the single most annoying topic when trading, but it's probably one of the most important, if not the most important topic. It's very important to make sure that you have started trading with a demo account. I'm just going to say that to start off before you begin trading with a live account. Brokers offer demo accounts to trade with fake money on the live markets for free. You should get comfortable with your trading platform, placing trades, and the entire trading process on a demo account before trading live, because why waste your money? It's a huge risk, and why do that? So, demo to live. I just want to touch on this too before we begin, that when you switch from demo to live, you need to change your mindset and some of your practices. When switching from a demo account with a 3K to 50K plus balance, you should not expect to be able to use the same exact lot sizing, same number of trades on a live account with a smaller balance. So if you're on a live account that's got $100, $1,000, $1,500, but your demo account was 3K plus, you need to adjust your lot sizing and probably your leverage accordingly. It's also important to know that for smaller accounts, it's better to place less trades, like I mentioned earlier, to avoid margining out or blowing the whole account. We'll go over this as well, paired with lower lot sizing, which we'll also go over, which is more proportional to your balance. All of this is going to help you lose less money, and that's the goal, right? Lose less money, then we learn how to win it. Also, don't trade blindly, guys. If you're taking signals, if you're on an account, don't just enter into trades blindly. Learn why something's being called, learn analysis, study, figure out, what's going on in whatever trade you're entering into. Otherwise, when the market starts going too far in the opposite direction, you're gonna freak out. And how are you gonna prevent yourself from that? How are you gonna prevent yourself from exiting out of trades that could go into your favor? You gotta learn to control yourself. Otherwise, you're likely gonna lose money. All right, so let's go over some terminology, guys. So, terminology. Balance, the amount of money that you have in your account without any open trading positions. Equity. Equity is the account balance plus the floating profit/loss of your open positions. Leverage is used to execute trading positions greater than your account balance. Leverage can be used to greatly improve your profits on winning trades, guys, but it can also cause you to lose a lot of money if you don't know what you're doing. The higher the leverage, the bigger the risk. The more leverage the more you can leverage the account of a balance of any size. I mean, leverage can get crazy. To calculate the leverage being used on a trading account, divide the total value of an account's open positions by the total margin balance. And if you look in MT4, you can find your margins near your balance amount, and your total open positions are going to be your open trades. Now, margin. Margin goes hand in hand with leverage. The margin is the amount set aside from your free equity required to open a new trading position. If you have a margin balance of $100, a leverage of 100 to 1, with a 1% requirement to open a new trading position, you would be able to open a position worth $10,000 or 100 times your account. The higher the leverage, the higher the available margin percentage on the account. This is why you will hear many people say not to open too many positions or trades in one account. When factoring in the leverage and the margin, if you're using lot sizing that is too high for your account balance, or your cumulative lot sizing for multiple positions is too much, your account will end up falling under the required amount to keep your positions open. This is how you can end up getting margin called or blowing your account. This will result in you losing all of your money if you blow your account, guys, which nobody likes. So we're going to go over even more proper risk management stuff to help prevent this. So let's finish the terminology. Free margin or usable margin. Free margin is the difference of your account equity on the open positions margin. This is the money in your account that is available to new positions. Kind of touched on this a little bit in margin. Now, margin required. The amount of money your broker requires from you to be able to open a position. It's expressed in percentages. That goes hand in hand with leverage, guys. Used margin. The amount of money that your broker has locked up to keep your current positions open. You still own this money, but you cannot use it until your broker, quote, releases it. which happens when you either close the current positions or when you receive a margin call. Now, a margin call is when the balance of your account can no longer cover your possible losses. This typically occurs when your equity falls below your used margin. We went over, we went over the used margin just barely. So margin call level. This is the level determined by your broker. When you have losing positions open, your margin level goes down. And when you have winning positions, your margin level goes up. Well, pretty simple, right? When your margin level hits the call level, you will no longer be able to open any new trading positions. This doesn't mean you're stopped out, you just can't open new positions. Margin level is the ratio percentage of equity to margin. For example, when your equity is 1,000, the margin is also 1,000. The margin level will be 1,000 divided by 1,000 or 1, 100%. Stopped out level. Now, this is what we don't want. When your margin level dips too low, your broker will start closing out your losing positions by order of the biggest losing position to lowest until the margin level is above the stop out level. If you've ever been in a broker like Trader's Way where they've given you a bonus and you've got a bunch of trades open and all of a sudden a trade gets stopped out and then your bonus goes away, you lose the money from the negative trade, it's like a double whammy, guys. You got to be careful with getting stopped out. You got to be careful with your margins. Once the margin level goes above the stop out level, your broker should not automatically close any more positions. But if it dips down again below that stop out level, you're gonna get margined out again. And if your account gets margined out all the way on all your positions, then that's what we call blowing the account. So now that we've got some terminology down, let's actually dive into some risk management. So let's start off with how much you want to risk. Many traders talk about 1 to 5% risk management. Some even talk about 10%. In other words, this means only risking a certain percentage of your account at any given time. Not risking more than 1% of your account is considered a more conservative approach. Keep that in mind. And the growth of your account is going to be slower the less you risk. However, it all comes down to how much you want to risk versus the reward. Following a 5% approach. If your balance is $100, then 5% of this would be $5. This is a conservative but safe approach because it means you would only stand to lose the $5. The higher amount you risk, the bigger the risk of the account getting margined out or blowing the entire account like we just talked about if you're not careful. Now, margining out, stopping out, this is all going to depend on lot sizing, account leverage, and how many open positions you have. We went over a little bit of this before in the terminology section. But the proper risk management, your risk to reward. For proper risk management to work, you should be targeting at least 2 times what you're risking. So if you're taking profits at an account increase of 5%, then your risk should be about 2.5%. If you're risking 5%, you should be looking to take profits around 10%. This is a 1 to 2 risk to reward ratio. The reasoning behind this is that if, for example, you keep the risk at 5% and the reward at 5%, then you can maximize growth and minimize your loss. Keep in mind that this is only a moderately conservative method, as we previously mentioned. Many Forex traders only believe in risking no more than 1% of your account on any trade. Some believe in risking 10%. It just depends on who you ask. You need to decide for yourself. But a huge goal in trading is to make sure your account survives to the next day. Really, you want it to survive as long as possible. But if you can get to the next day, well, then you've at least gone one day farther. You need to pick the risk to reward ratio that will work best for you, because at the end of the day, you're responsible for whether you win or you lose money on the market. That's an important key concept. You're responsible. You enter the trades. You pick everything you do. Even if you're listening to someone else, you still did it. Keep that in mind. With a 1 to 2 risk to reward ratio, you can win today, lose tomorrow, or lose today and win tomorrow again. It's all about being able to trade another day. Same can be said for risking only 1% of your account or 10% of your account. Now, let's get into applying risk management. Utilizing a stop loss. This is another key risk management point. It's up to you whether you use one. Some profitable traders don't use stop losses. They don't believe in them. And there's some good reasons why you shouldn't, but there's also a lot of good reasons why you can. If you're new, it's considered a good practice to use a stop loss. This can prevent the market from moving too far against you more than you are willing to risk. And that's the key point right there. More than you're willing to risk. The stop loss stops you from losing more than you're willing to risk. You need to set your stop loss based off your account balance and what you're willing to risk. If your account cannot handle the retracements on a longer term trade, for example, or the market moving against you without a stop loss, your account's going to get blown. It's going to blow through whatever trade you've got. Nobody likes the feeling when your account is blown or you're stopped out or anything like that. So learn to be careful when you're opening those trading positions. And while you're new, use a stop loss. If you choose not to use a stop loss later, that's your choice. But start out with one, get the feel for one. All right, let's get into some leverage. Leverage, also referred to as margin, is a loan that's provided to a trader by the broker that is handling his or her Forex account. Earlier, I mentioned that leverage can increase your purchasing power when trading. For example, if you achieve a 25% return on a $1,000 trade that was carried out with 2-to-1 leverage, you actually achieved 50% return on the capital that you personally invested. The other half is typically provided in the form of a loan by the broker. This also means that the opposite is true, and the 25% loss would be magnified into a 50% loss. This is why you need to choose leverage carefully. Properly using your leverage, if a broker requires you to maintain a minimum of 2% margin in your account, this means that you have to have at least 2% of the total value of an intended trade available in the cash in your account, your balance, before you can proceed with the next order. Using a ratio of 50-to-1 as an example means that it is possible to enter into a trade for up to $50 for every dollar in your account. 100-to-1 would be 100, and so on. Leverage depends on what is offered by the broker. Different brokers offer different leverages. It can go all the way up to like 3,000-to-1. It gets crazy. You can choose which leverage is best for you, but you need to be very careful. Do not be afraid to ask your broker to change your leverage and experiment with leverages, guys. Figure out which ones work for you. Some leveraging tips. Over-leveraging your account is one of the biggest account killers for traders, especially you new guys. Over-leveraging your account can cause you to lose money often, even if your analysis is winning, because you have less breathing room before your account can be margin called. You can be an experienced trader. You can have great analysis. You can know what you're doing, but that leverage can kill you. Lower leverage is going to help your account survive longer. This is helpful while you're learning. Higher leverage is riskier. So if you're going to use higher leverage, do so once you've learned. Why risk it? Let's get into some lot sizing. It's crucial that you use proper lot sizes for your trades. Very important. The higher the lot size, the bigger the return. The inverse is also true if the markets move against you, though. The higher the lot size used in your trades, the bigger for potential loss. The risk raises exponentially if you have multiple trading positions open with high lot sizes, or a couple of high lot sizes and a couple of small lot sizes. Either way. Same can also be said for having too many positions open. No matter if it's high or low, you've got to be careful with that. The point is not only to use proper lot sizing, though, but like I said, reiterating, not too many open positions. So how do we use proper lot sizing in order to grow our account? Because that's what we're all here to do, grow our accounts. To try and maximize the growth of your account while minimizing risk, I'm going to show you a conservative lot sizing chart. This is conservative, but keep in mind, this is an example chart. You're trading at your own risk. If you choose to follow the chart, you're doing so at your own risk, with the understanding that no matter what lot sizing or risk management prevention measures you're using, you can still lose money when trading on the market. Just keep this in mind. We're here to consult you. We're not here to tell you what to do with your money. So here it is. You can see here, 100 to 400, very conservative, guys, very conservative. A lot of people, when they get to like even 1K, some of them use standards. Standard is 1.0. Some of them get to 5K and start using standards. It really just depends. This is just super conservative to try to help you keep your account open as long as possible, because proper lot sizing paired with proper leverage can be a powerful tool for growing your account. So I want to mention this. It's okay to lose. You should not expect to win every time. Even the greatest of traders lose sometimes. What you want to be able to do is win most of the time. If you're utilizing proper risk management and winning most of the time, losses tend not to matter very much. It's also good to note that if you lose 2.5 to 5% in a day, take a break. It's not mandatory, but this can help you clear your head and get your mindset and emotions back to where they need to be before you start trading again. Don't be afraid to walk away from the computer, guys. Don't be afraid to take breaks. Another thing, do not chase the money. chase the setup. This is so important. On top of using proper lot sizing, leverage, and placing a safe amount of trades for your account and equity and margins, it's important to remember not to let greed get the best of you guys. Everybody wants to make money. Without learning how to trade properly, you're just going to lose. So, I mean, come on, let's learn how to trade properly. Let's learn proper risk management. The point of using successful trading is not to open a trading position and make $100 on a $300 account. The point is also not to double the account overnight. The point is to use proper risk management and use profitable strategies in order to win trades more often than you lose, so that you can safely grow your account. If in a single day you make multiple trades that grow your account by 1 to 5% and risk only 1 to 5%, then this is great. Even if you made only 5% on your account daily, you would still be able to compound and grow your account to a satisfactory amount of your choosing. Compounding is key, guys. Compounding is when you win, say, 50 bucks or 10 bucks. The next trade you take is going to use your total balance plus that 10 bucks. Let's say you win 20 bucks next time and you had 100 bucks. Now you've got 130 bucks to use. Let's say the next trade you win 20 bucks. Now you've got 150 bucks, and that balance keeps growing. Every time you place a trade carefully, you've got more and more to use. Magic of compounding. Einstein himself said, or it was Einstein or Edison, can't remember. One of the two said compounding interest is magic. The same principles, they work in trading, guys. Part of how experienced traders succeed is because they are properly leveraging and risking their account for the safest and most profitable capitalization. Nuggets here. So that concludes our risk management video. For more free training and education, check out this link, our education tab. We've also got a free library for you guys. We've also got some paid education if you like. You can go to our trading school, check it out. We've got awesome mentors that can help you out, live classes, classroom of students, and you'll get 24/7 access to recorded videos. Thanks for watching, guys. Have a great day.